clearly it's very good news, and companies have adjusted very well to the to lockdown measures that we're seeing around the world. And certainly, the latest round of lockdowns is likely to have a smaller economic impact than the one we had back in Q2 of last year. So companies have adapted very well. That's good news. But remember, we just come through what was, for most asset classes, a pretty good year. If you look at the returns for most things last year, it was a pretty strong positive return. And there's the old saying about travelling and arriving. We've travelled a fairly long way. And whilst I'm not going to prepare to call the top, I think you just need to sort of dial back the risk a little bit. I liken it a little bit to the the school disco. It's the music's still playing, everyone's up on the dance floor, had a lot to drink, but the DJ is starting to look for the slower music. So I think dialing back the risk a bit is an appropriate strategy, but not abandoning equities.
David, let me quiz you a little bit on some of the market volatility we've witnessed this week. One might assume that longer-term investors are immune from some of the fluctuations we've witnessed, but it feels as though there are all sorts of ramifications. Hedge funds have been trying to move very quickly and convert some debt into equity to maximise what we're seeing with this retail speculation. Others are moving to long the credit, short the equity. So it feels as though there's all sorts of market manipulation going on because of what retail investors are doing with this coordinated activity on social media. Are you concerned, and what would you say about what we're witnessing?
I think it's dangerous. It's dangerous territory. I think there's scope for a lot of people, retail investors and institutional investors, to lose a lot of money in this sort of environment. I think the activity that we're seeing with hedge funds and shorting and covering shorts, I think that's another sign of the impact of excess liquidity, the extreme monetary policies, low interest rates are having on markets. It's extremely dangerous territory. I think fund managers, hedge fund managers, they're no different from the rest of us. They put their trousers on one leg at a time. And I think it's very dangerous when people are starting to be, when there's sort of signs of arrogance from market participants that they know better than everyone else. So I think it's a dangerous sign